A lot has been said lately about smart beta, but what is it really? Deepika Sharma, Director of Investment Research for Astor Investment Management, explains what smart beta is and why it is good for investors.
You've been hearing a lot about smart beta, but what is it really? Active or passive or something else? Last year, more than 200 billion flowed out of actively managed funds. On the flip side, inflows into passive funds soared by double that amount. On top of that, half of all the ETFs launched in 2015 were smart beta ETFs. We think that smart beta is just a new name for an old game. These strategies have been in use for decades as mutual funds and hedge funds and are now also available as ETFs. Broadly defined, smart beta is a rules-based, passive strategy that seeks to deviate from market cap-weighted indices. Why? Because market cap-weighted strategies have really underperformed, creating a risk premium for factors such as value, size, high dividend, minimum volatility, and so on. Investors like smart beta because it offers transparency through a rules-based approach, low expense ratios, and the opportunity to access alpha. As an active manager, we seek to embrace the right smart beta allocation models. That means we can focus on strategies that offer portfolio alpha rather than just alternative market beta. Not all smart beta strategies are alike, which makes them harder to evaluate with the same metrics investors are used to. For example, we looked at some of these smart beta ETFs that offer high dividends of more than 3%. They all use different rules, and as a result, different sector exposure, number of securities in the portfolio, and what matters the most, performance. Which brings me to the most important point that investors should be aware of, attribution, or in other words, is my strategy giving me the pure, empirically proven, and time-tested factor exposure that it says it is? Or is it something else in disguise? To figure out whether a smart beta strategy fits your portfolio, look out for the following. Number 1, are the underlying index and index weighting rules giving you exposure to the pure factor you need? For example, while the outperformance of the value factor has been well documented by Fama French, it relies on a clear boundary between value and growth stocks. However, in reality, the Russell's 1000 value and growth indices share around 300 securities that are both value and growth. Number 2, are these factors for real and time-tested? Looking only at the top journals, the number of factors discovered have grown from 1 per year in the 90s to 18 per year in the last decade. Clearly, supply of factors is rising to meet the demand. In fact, according to a 2013 study in the Journal of Portfolio Management, sometimes inverting the factors into upside-down signals still gives you outperformance, which means that there may be other biases at play. Number 3, be careful of data mining, especially in multi-factor strategies that combine 3 or 4 factors into one wrapper. To start with, we all know data mining creates biases. It makes you believe there is a reason for our performance just because the backtest looks good. There's more danger of this happening with multi-factor or untested, newly discovered factors. An NBER study from July 2015 called Backtesting Strategies Based on Multiple Signals showed that selecting 3 out of 10 best factors produces the same amount of distortion and bias as selecting the best strategy out of 1,000 backtested factors. Our own research shows similar results when we compared a few smart beta indices after they went live. We discovered that on average, the alpha decreases while its beta, the return from market risk, increases, showing that out of sample, smart beta may really be dumb beta. So in conclusion, watch your backtest, check for data mining, self-evaluate the factors, and apply stricter Sharpe ratio thresholds.
To find out more about how Astor can provide you with portfolio solutions, please visit our website at www.astorim.com.